Hello guys. So we are now into our second session into transfer pricing, and in the previous session we had gone through the basic provisions and started off with the introduction to transfer pricing. We understood that there are three components to transfer pricing, primarily being number one, the international transaction has to be there, and two, such international transaction has to be between associated enterprises, and three, when these two elements are present, the transaction should be at arm's length. Okay, so section 92A dealt with the definition of your associated enterprises, which had three classifications or broad classifications in nature. One was being the capital, which was 26% of shares, and two being the management aspect, where half of the board of directors or more than half of the board of directors and the one executive director being appointed by the other enterprise or two of such enterprise was considered as the management point. And finally, we came into the third bracket of control, which had the borrowings, guarantee, raw material purchase, technical know-how, and the partnership point, and also the HUF and individual points. Now, we understood the international transaction to also cover what is called as tangible property purchase, intangible property purchase, financing options, and various sorts of other transactions, even cost sharing and also expenditure sharing was also brought under the purview of international transactions. So these are the broad things that we have seen in the previous session on what was an associated enterprise and what are the international transactions. In doing so, we also understood something called as a deemed international transaction. Now, the next major area of focus is going to be the third aspect of this entire study, which is arm's length. Now, till now, we have not defined what is arm's length. We have defined what is associated, we have defined what is international transaction, but unless until we define arm's length pricing, there is no point in studying transfer pricing at all. So now, our focus is going to be towards section 92C. Now, this 92C gives us five methods to arrive at arm's length price. 5 methods for ascertaining ALP, arm's length price. Now onwards we will be referring to it as ALP, which refers to arm's length price. Okay. So now, what are the 5 methods? Now, Rule 10B gives us 5 methods. Okay. So method number 1 is going to be comparable uncontrolled price method. Then Rule 10B gives us the second method, which is going to be resale price method. Then the third method that is given by this particular rule is cost plus method. Then the fourth method that is prescribed is going to be profit split method. And then finally, the last method prescribed is transactional net margin method. Transactional net margin method. So, if you see, for short, we call this as CUP, we call this as RSP, and then this is CPM, this is PSM, and this is PNMM. Okay, so these are the 5 methods we will be studying. So, is there a possibility that there could be some other method also? Yes, but that is a method which is not specified. That method is given as a prescribed method. So, based on scenarios which do not get captured under these 5 methods, where the assessee and the assessing officer feel that this particular transaction cannot be covered, and then the assessing officer is sure that the 5 methods cannot be adopted, then they can go for the last method, which is provided under Rule 10AB. Okay, so this is a prescribed method. So prescribed method. Now there is nothing prescribed actually. So what they want us to do is, they want us to make sure and also convince that none of the 5 methods prescribed above can be applied to a given scenario. So we are resorting to this method owing to the facts of the particular transaction. We are to approach rule 10AB to determine the arm's length price. Okay, so this generally is not tested. So the area of focus or study will be only these 5 methods. Okay, where you will be able to understand what is the methodology or mechanism for deriving the arm's length price. Now, please understand, before we jump into the conclusion of applying any of these methods, we have to ensure 2 things. One, there has to be associated enterprises. 2, there has to be an international transaction. Only if these 2 are satisfied can you proceed to the next level. Without that, you cannot. Okay, so now that we have understood, let us do one thing. Before we go into each method, we will try to understand what is that particular method trying to advocate, and then we will look into a problem to see how that method is implemented. Okay, so now the first method. What was the first method that we discussed? Comparable uncontrolled price. Now, as the name indicates, where I am doing 2 sets of transactions. What are the transactions? One transaction I do with my associated enterprise. Other transaction I do with an unrelated person. Okay, the same transaction. For example, I purchase a particular product from my associated enterprise. The same product I purchase from another person also. Now, this transaction with the associated enterprise can be compared with the uncontrolled transaction. Why? Because the transaction with the associated enterprise is a controlled transaction. The transaction is influenced transaction, tainted transaction. But when I do it with another person, it is not controlled. Therefore, I can happily proceed with the transaction and check whether these 2 transactions are on same lines. These 2 transactions are on same lines. This is called as comparable uncontrolled price method. Okay, now how do we do this method? Always remember, what is the goal? What is the intention? The intention is to make sure that whenever I sell to my related party, I am not influencing the price. So what should I tell? I should start with the price which is a non-influenced price, or which is a non-biased price or unbiased price. So always start with uncontrolled price. Okay, you start with uncontrolled price. Always start with uncontrolled price. Now, not always can we tell that 2 transactions are same. Okay, sometimes what will happen, there might be some sort of adjustments that might happen between 2 different parties, which will not be exactly the same for the other party. Let us understand how and when we come to those adjustments. So we take up the uncontrolled price, and then we add or less adjustments in relation to transactions with associated and unrelated enterprises. And then you arrive at what is called as arm's length price. So what is this adjustment, sir? Don't worry, we will take up these adjustments and understand why they are also adjusted. Don't worry about that. So first let us see what needs to be done. So you start off with uncontrolled price. Okay, so this is the price you charge to the outside entity or a third party. Then you make changes in that transaction for whatever is the adjustment that has to happen for a third party and which has to not happen for an individual, related party. So we take up the transaction of a related party and a third party, see what are the terms of the transaction, whether freight is borne by the person, whether a discount is given to the person. If these 2 are not common between these transactions, we will eliminate those inconsistencies to arrive at the correct price. So this is called as the adjustments. Once you do that, you arrive at the arm's length price. Okay, once you do this, you arrive at the arm's length price. Now, when can this method be applied? So, when can this method be applied? First thing, there has to be comparable uncontrolled transaction. There has to be comparable uncontrolled transaction. So, if the business has comparable uncontrolled transaction, then it is possible for the business to go ahead and tell, see, I have done a transaction with a third person, I have done a transaction with a related party, both are same, so no problem. I am already at arm's length. So the business should have data to tell that my transaction is also done by somebody else or by me to somebody else, therefore I can compare. So what should be done? I should have a comparable uncontrolled transaction in my business itself. I should not sell only to an associated enterprise. I should sell to associated enterprise and also to a non-related person. Okay, or I can sell to an associated enterprise, but same type of a sale has to be done between two different third parties. So what can be done? I should sell to an unrelated party and I should sell to a related party. Then I can compare and contrast, provided the sale is same. Or I sell entirely to unrelated party, for example. Can I still apply comparable and controlled price? Yes, provided exactly same type of product is being sold by two different unrelated parties. Okay, so that is why there is a concept of internal comparable uncontrolled price and external comparable uncontrolled price. Right? Too many concepts have been packed in. So let us take a numerical, let us take an example so that you will be able to understand it better. Now, I am sure that you must have downloaded the PDF that is given below, which has a problem. Take problem number 1. This problem we are now going to solve to understand the implication of comparable uncontrolled price method. Okay. So, Acer Singapore Pte Limited is holding 65% in Acer India Private Limited. So, we are sticking on to our old example, which we considered during the application of section 92A and 92B. Okay, Acer India is the party for whom we are now trying to advocate the entire transaction. So, there are two parties. What are they? This is Acer, let us keep it in short, ASPL, Acer Singapore Pte Limited, and the second entity is Acer India Private Limited. Okay, Acer India Private Limited. Now, Acer Singapore is holding holds 65% shares. So, which means what? Greater than 51%. So, this becomes the parent entity and this is the subsidiary entity. Okay. Now, whether they are associated enterprises? Yes. Why? Because greater than 26% of shares are being held. Therefore, these two are associated enterprises. So, please, at every point in time, keep checking whether the important aspects of transfer pricing are satisfied before we jump into arm's length price. What is the first one? Whether they are associated enterprises? Yes, they are. Now, the second point. Sells 1000 premium gaming laptops to Acer India Private Limited. So, what is the transaction? The Singapore entity is selling, selling 1000 premium gaming laptops. Sells 1000 premium gaming laptops. At what rate? At 1,25,000 per laptop. At rupees 1,25,000 per laptop. Once again go back. Section 92A, whether satisfied, whether they are associated enterprises? Yes, because more than 26% of share capital of the other enterprise is held by this enterprise. So ASPL holds more than 26% of AIPL, so they are associated enterprises. 2. Whether there is an international transaction. ASPL is located in Singapore, AIPL is located in India. So there is a transaction between a non-resident and a resident. Section 92B says that there has to be a transaction between non-resident and resident, or non-resident and non-resident, only then it will be constituting an international transaction. So whether this is an international transaction, yes. So 92A is satisfied, 92B is satisfied. So we are telling that there is a sale of 1000 laptops by ASPL to AIPL to the extent of 1,25,000 per laptop. Okay, now let us get back to the question. Acer Singapore Pte Limited also sells 500 laptops to TAXATION India Private Limited unrelated at 1 lakh per laptop. So ASPL does not sell only to AIPL. Okay, so what it does is it also sells to the other parties, one more party. What is that party? That is TAXATION, correct? TAXATION India Private Limited. So I will name it TIPL. So TAXATION India Private Limited. And how many units are they selling? And they are selling 500 laptops at 1 lakh per laptop. So sells 500 premium gaming laptops at rupees 1 lakh per laptop. Okay, now understand something. Whether transfer pricing should be applicable here. They are associated, there is an international transaction, but when we compare the transaction between the associated enterprises and unrelated party we understand that the price for this transaction has undergone a change. They are charging 1,25,000 per laptop to the associated enterprise and only 1 lakh for the purpose of a third person. Now, whether there is a comparable transaction, that is the first question we have to ask. They are selling the same premium gaming laptop to a third person and to the associated enterprise. So can this be compared? Yes, it can be compared. So I can compare and tell Acer Singapore will sell only at rupees 1 lakh to its customers, but to its own parties, related parties, it will sell at 1,25,000. So is the transaction comparable? Yes, it is comparable. Now we have established that transactions between a related party and an unrelated party are same and can be compared. We can apply this method called as comparable uncontrolled pricing method. But the transaction does not stop there. Okay. Now Singapore is giving us some additional information. So what is Singapore trying to tell? Singapore is trying to tell the following. The freight cost for transportation to Acer India is borne by Acer India. So freight, okay, this is broken into two. One is for AIPL and the other one is for TIPL. AIPL cost is nil. Why? Because ASPL does not incur any freight cost for AIPL. But when it comes to TIPL, does ASPL incur any freight cost? Yes, transportation cost amounts to 5,000 per unit. So for every unit sold, 5,000 rupees of transportation cost is incurred by ASPL. So will they factor that into their price? Yes. So what will ASPL do? Cost of production is so much, cost of transportation is so much, I will add my profit to this. This is my selling price. That selling price is 1 lakh for TIPL. Okay, but when it comes to AIPL, they just produce and they send it as FOB, whereas cost of transportation is incurred by AIPL. So ASPL does not incur any cost. Therefore, to that extent, selling price should be lower because they don't have additional cost. Therefore, this is a point of adjustment. Okay, so let us see how this adjustment happens after we come through the entire set of adjustments. Now, the second adjustment. Additional coolant fans and gaming mouses are provided to laptops sold to Acer India Private Limited at the same, and this cost of the same amounts to rupees 5,000 per unit. So what are they providing? Gaming mouse coolant fans. This is provided to which entity? This is provided to AIPL and not provided to TIPL. And what is the cost incurred for this? 5,000 rupees. So when they sell this gaming laptop, they sell along with two additional accessories, then they sell it to AIPL. So more cost is incurred by ASPL for that transaction. Whereas for TIPL, these two transactions are not incurred. Therefore, the cost is lower to that extent. So this is an additional adjustment which needs to be considered for transfer pricing. Now, is there anything else? Come back to the question. Discount offered to AIPL is rupees 1000 per unit. Okay. So what are they telling? Discount. Only AIPL gets a discount, that too 1000 per unit. Fine. Then both discounts and additional parts are not offered to TAXATION. So TAXATION is not getting the discount, TAXATION is not getting the additional parts also. After sales warranty for rupees 5,000 per laptop was given to Acer and not to TAXATION. 3 after sales remote services offered to Acer India amount to 6,000. So in addition to these two adjustments, two additional adjustments are here. What are they? Warranty is given only to AIPL at a cost of rupees 5,000 per unit. Then, it's not warranty, it is warranty. And then, after sales services, remote services is given only to AIPL at 6,000 per unit. So this is the entire transaction that is given to us, asserting ALP. So they want us to find arm's length price after considering the following adjustments. Okay, so now let us understand how to go about the arm's length price. Where do we start? Now please try to understand what is the entire purpose of this exercise. We have to find out a price which is not influenced, which is not biased, which is not tainted. So we should check whether the price we have actually quoted for our related party is right or not. We should check what? Whether the price quoted or received from our related party is right or not. So for that, we should know what is right, correct? Before calling something as wrong or right, we should know what is right. So therefore, always under comparable uncontrolled price method, start off with the uncontrolled price. Uncontrolled price. Okay. What is the uncontrolled price? Price which is sold to TIPL. TAXATION is the uncontrolled price. Correct? So you will go ahead and take the TAXATION price. What is the TAXATION price? Per laptop they charge 1 lakh rupees. Okay, sir. TAXATION is from Singapore. How rupees? No, forget all that. We are now more focusing on the conceptual understanding right now. So let us not jump into the SFM and understand the forex fluctuation or forex reporting that needs to be done in foreign currency, etc. Let us not jump there as of now. So the uncontrolled price is rupees 1 lakh. Now, let us check the functional differences or transactional differences between AIPL and TIPL. What is the first difference? Less cost of freight. How much is the cost of freight? Cost of freight is 5,000. Sir, why less, sir? Now try to understand. 1 lakh is the price charged to whom? To an unrelated party. To this unrelated party, am I providing freight? Yes, I am providing freight. Now, what am I trying to arrive at in this problem? What am I trying to arrive at? I am trying to arrive at the price that should be charged to a related party. Okay. Now, to the related party, am I incurring freight or not? No, I am not incurring freight. Okay. So, what has happened here? For the unrelated party, I have incurred freight. For the related party, I don't incur freight. So, there is a policy difference. There is a policy difference, or there is a sales terms difference here. Okay, the terms of sales slightly different here. That cannot be penalized as charging a differential rate. So what we will do is we will convert the unrelated price to related terms. We will convert the unrelated price to related terms. So what will we do? 1 lakh is a price that I have charged after including 5,000 worth of freight. Correct? Now, when I am going to sell it to a related party, I will not incur this freight. So please remove the freight. That is why I am reducing it. Is it clear? Please try to understand. 5,000 worth of freight is charged only to a third party. It is not charged to AIPL. Okay. Now, when I am going to arrive at the price required for AIPL, this is a cost that is not required for that price. So please remove that cost. So 5,000 will be removed. Okay. Now, next adjustment. They are giving us this gaming mouse and the coolant fan. Okay. So what I am going to do is add, how much is it? 5,000. Accessories received or given, sorry, not received, given. Accessories given 5,000 rupees. Now try to understand why we have added this. Where are we starting from? We are starting from an uncontrolled transaction. In this uncontrolled transaction, are we giving this mouse and coolant fan? No, we are not giving the mouse and coolant fan. But for the related party, we are giving these two facilities, which is an additional cost, I am bearing, which I will push on to my customer. Okay, it's an additional cost I am bearing, I will push on to my customer. Therefore, increase the cost or increase the price by this extent. What extent? Rupees 5,000. Clear? Why did we reduce freight? Because that was not going to be incurred for the purpose of the related party transaction, so it is not relevant, so we are removing it. Now when it comes to the accessories given, this is a relevant cost for the purpose of related party transaction, therefore add it to the unrelated price to arrive at the related price, which is at arm's length. Okay, now what additional information is given? Discount of 1,000 per unit is given to Acer India. Okay, so less volume discount 1,000. Now why are we reducing this? The price charged to unrelated party TIPL is 1 lakh per unit. But he has purchased how many units? Only 500 units. But AIPL has purchased 1,000 units, 1,000 laptops. Because of the increase in volume, AIPL has been able to get what is called as a volume discount. This volume discount is not available to TIPL, but as per the terms of sales, as you keep buying in larger quantities, you are eligible for discount. Okay, therefore, these guys have got a discount of 1,000 per laptop. This is a normal term which happens in every day-to-day business activity. So we will adjust it from the unrelated price. So we will reduce the unrelated price because the unrelated price does not have discount. But for related party, we must include discount also. Therefore, we are reducing it to arrive at the arm's length price. Okay, now what else is there? We have cost of warranty, after sales warranty of 5,000 per laptop. So what is it going to be? Add cost of warranty. $5,000 per laptop. And then let me finish the other transaction as well. Add after sales services $6,000 per laptop. Okay, so now after sales services and warranty is given only to the related party, it is not given to the third party, it is not given to TIPL. So now we are using the price of TIPL as base to arrive at the price of AIPL. So what should we do? These are additional costs incurred by ASPL. The Singapore entity incurs extra cost for the Indian entity, that is AIPL. Therefore, these costs should be added to arrive at the price to be charged. These costs should be added to the unrelated price to arrive at the price to be charged. So, now that we have taken every single adjustment into consideration, we will arrive at what is called as arm's length price. Okay, so how much is the arm's length price? So, this is 10. Okay, This is 11 and then this is 10. Okay, 1,10,000. So which means what? ASPL. So ASPL should sell to AIPL at rupees 1,10,000 per laptop. So ASPL should sell to AIPL at 1,10,000 per laptop. But quickly look into the question. What is the rate at which they are selling? But ASPL is selling at what? 1,25,000. Now what has happened? AIPL, okay, let us say they are preparing the P&L account. The P&L account, two purchases, he will show 1,25,000. But how much should he show? He should show only 1,10,000. So what has happened? Excess cost booked by AIPL is equal to 15,000 per laptop. Therefore, income of AIPL to be increased by 15,000 into 1,000, which is equal to rupees 1 crore 50 lakhs. So this is the adjustment that you will have to pass. Who's the you? AIPL has to consider. What will AIPL do? AIPL will work out the transfer pricing implication, that is the arm's length price workings, and it will tell that Singapore friend, my dear Singapore friend, you have to sell it to me at 1,10,000, but you have sold it to me at 1,25,000. Now what I will have to do is excess 15,000 rupees which I have paid to you is not correct. Therefore that will be treated as my income and I am subject to pay tax on the same. So 15,000 rupees of excess amount of money which I paid for each laptop will now be treated as my income, because only 1,10,000 can be charged. But since they have charged me 1,25,000, this 15,000 rupees additional amount which I have paid per laptop for 1,000 laptops will become my income, which is addition or added to my profit, which is chargeable to tax. Okay, this is called as comparable uncontrolled price method. So what will we do? We will take the uncontrolled transactions price. We will make adjustments for various differentials in the transactions. What is provided to the unrelated party, not provided to the related party. Or other way around, what is provided to the related party, what is not provided to the unrelated party. So we will see these transactional differences and we will arrive at the arm's length price. And after arriving at the arm's length price, we will compare it to the transactional price. Okay, the transactional price is 1,25,000, arm's length price is 1,10,000. So 15,000 rupees, there has been an overstatement of expenditure. Because of overstated expenditure, India has lost revenue to that extent. So 15,000 into 1,000 will be the revenue that has to be given back to India. So this is what will happen with respect to comparable uncontrolled price method. So this will be the addition to income, on this tax will be paid. Is it clear, guys? So this is comparable uncontrolled price method. Now, in its application, what are the challenges that we will face? So let us take an example. So there are 3 entities. Okay, this is ASPL, this is AIPL, and this is TIPL. Okay, these two are related parties. So therefore they are associated enterprises. These two are AEs, associated enterprises. Now, let us say, for example, ASPL is selling to AIPL and ASPL is selling to TIPL as well, just like our previous example. Okay, so here the sale is at 1,25,000. Here the sale is at 1 lakh. So same product has been sold to an associated enterprise and to a third person. Therefore, CUP method can be applied. Comparable uncontrolled price method can be applied. Now, this entity has sold to its third person or the unrelated person and to a related person. Therefore, I can take this price itself as the CUP price. For example, I can take it as CUP price, assuming there are no adjustments at all. 1 lakh will be the CUP price. This CUP, which is generated from a transaction within the enterprise, that is, the enterprise is selling to an unrelated person and to a related person. So the same enterprise is trying to sell to both these persons. Therefore, this is called as internal CUP. This is called as what? Internal CUP. Now, the same scenario, the same example, assuming that TIPL does not exist. Okay, let us take, for example, there is no transaction. Entire output is sold between ASPL and AIPL. Now, there are two other enterprises. Okay. This enterprise, let us call it ABC Limited, and this is XYZ Limited. These two are selling the same gaming laptops. So, same gaming laptops. Now, they are charging 1 lakh for this transaction. Now, can this be considered as comparable and controlled transaction? Well, first we have to answer the following: whether these two are the same products. Yes or no? Yes, because same gaming laptop is considered. So, same gaming laptop is considered. So, the product is the same. Now, this type of comparison where we are using an external transaction to compare our internal transaction, this is called as external CUP. Where I do not have a comparable transaction within my enterprise, but there are two other enterprises which deal with the same transaction or almost similar transaction, then they can be considered as CUP, external CUP. Where I deal with both internal and unrelated transactions, I can take my own unrelated transaction as CUP and call it as internal CUP. So this is how comparable uncontrolled price method is applied. Now, from a practical point of view, when it comes to practicing transfer pricing, or you want to take up a career in transfer pricing, you will understand that. You will take up your entity and you will identify entities which are on same scale, which do the same type of businesses, etc. And you will have to collate data relevant for the particular transaction. Suppose there is a purchase transaction, you will have to see the entities which are of the same size, which have the same amount of risk involved, which perform the same functions, which have the same assets employed, etc., which is called as FAR analysis, or the same functions performed, assets employed, and risks assumed analysis. Based on that, you will find out comparable companies. These comparable companies will then check for data which are similar, and then you will see whether external CUP can be identified from the data available. If external CUP can be identified, then you will value the particular international transaction using the CUP method. Okay, so this is how CUP method is applied. Fine. So the first method that we have seen so far is comparable uncontrolled price method. What is this method? I will report for a transaction which is verbatim same within the organization that I perform, or the company that I perform, two different types of sales, one to related party and the other to unrelated party. The transaction with the unrelated party will be compared with the transaction with the related party, and then we will conclude whether both these transactions are at the same level or not. That is called as arm's length. Okay, so now let us take the second scenario. What is the second scenario that we discussed? Resale price method. So when will this method apply? This method will apply when purchases are made from AE, associated enterprises, and sold, that is resale, to an outsider. So So this is predominantly like a trading activity. You purchase in lots from your associated enterprise and you entirely sell the lot to an unrelated party in India. So this is the case where you will apply the resale price method. Okay. So now, before we get into the nuances of understanding this method, what I would suggest is we will take up an example which is there as part of your handout, and then we will solve a problem to understand how to go about this method. The question that is given here is Acer India Private Limited purchased professional laptops worth 50 lakhs from Acer Singapore Pte Limited. Acer India incurred freight amounting to 2.5 lakhs and customs duty amounting to rupees 7.5 lakhs in importing these laptops. The laptops were sold by Acer India to Zebronics India Private Limited at 75 lakhs. The normal GP margin for Acer India Private Limited in an uncontrolled transaction is 30%. Okay, so this is the data that is given, and they want us to find out the arm's length price. Now, let us understand something. Sir, can we apply comparable uncontrolled price here, sir? Now, if you look into the question, they have given us that my parent company has sold laptops to me. Okay, so let us try to give a diagrammatic representation of this transaction so that we get a better understanding. So one entity, this is ASPL, and then the second entity, namely the Indian entity AIPL, and the third entity is Zebronics India Private Limited. Okay. So Zebronics India Private Limited. Now, since we already know that we are associated enterprises, that is ASPL and AIPL are associated enterprises, so let us not delve into that. So there is a purchase here. Okay. Sale of professional laptops. Now, what happens here? This in turn is being sold. So, resale of professional laptops. And what is the rate which we are reselling it? We are reselling it at 75 lakhs. And what was the rate at which we purchased? It is 50 lakhs. Now, whether cup can be made applicable. Now, the question has not given us information regarding a comparable uncontrolled transaction. The question does not give us information regarding a comparable uncontrolled transaction. So, what about in real life scenarios, sir? Suppose for this transaction, we are unable to find out comparable data from comparable companies as to what is going to be the selling price, what is going to be the additional differences, etc. So, we cannot apply cup method here. Why? Because we are not given a comparable uncontrolled transaction to check with. We don't have any measurement to check with. So now we are forced to resort to a different method. So how should we start? Again, the principle does not change. Under comparable uncontrolled price method, what did we do? We told that we will start off with something which is a reliable number. We will start off with something which can be called as the correct number. So we started off with what? The uncontrolled price. So is there anything called as uncontrolled price here? Yes. Where? The price at which they sell to Zebronics India Private Limited is an uncontrolled price because it is a third party. He is no way related. Okay. So the price to Zebronics India is called as resale price. Okay. Resale price to Zebronics India Private Limited. How much is that? 75 lakhs. Now, look at the last line of the question. The normal GP margin for Acer India Private Limited and uncontrolled transaction is 30%. What is the meaning of that? Suppose Acer India purchases professional laptops from an unrelated person and resells these laptops to an unrelated person. So what is the scenario? Acer India purchases it from an unrelated person and sells it to an unrelated person. then the margin is going to be 30%. What is gross margin? Gross profit by sales is called as gross margin. So in that case, gross margin is going to be 30%. But in this transaction, what has happened? They have purchased from a related party or an associated enterprise, and they have sold it to an unrelated party. So the transaction as a whole is not at arm's length. The sale might be at arm's length, but the purchase could be questionable. So now we are going to check whether it is at arm's length. So how do we do that? Resale price is 75 lakhs. So this resale price is to a third party, therefore it is reliable to consider this as unrelated price. Had I purchased from an unrelated person, what will be my gross margin? 30%, correct? What is the question telling? Had I purchased from an unrelated person and sold it to an unrelated person, my margin will be 30%. Therefore, less gross margin at 30%. So how much is the gross margin? 22 lakhs 50,000. Okay, so this is the gross margin. Now, since I have gone for purchase from a foreign vendor or from a related party for that matter, what has happened? I have ended up paying customs duty and I have also incurred freight charges. So these two expenses I have incurred. Because of going to a foreign dealer, I have incurred this cost. If I had gone in-house, I wouldn't have incurred this cost, correct? So these costs are specific costs. These are adjustments which have been incurred for the purpose of international transaction. Therefore, adjust those adjustments as well. So freight cost. How much is the freight cost? 2,50,000. And then customs duty has been paid. Customs duty has been paid for 7,15,000. Okay, so now this has completed and arrived at the arm's length price. So we have considered the gross margin which will arise in an unrelated transaction. We have given effect to the specific expenses of purchases which have come across on account of the international transaction, and now the balance that we arrive at will be called as the arm's length price. What is the arm's length price? 42 lakhs 50,000. How much is it? 42 lakhs 50,000. So what is the meaning of this? AIPL should have purchased from ASPL at what rate? 42 lakhs 50,000. But look into the question. They have purchased from ASPL at the rate of 50 lakhs. Are you able to understand? Instead of purchasing at 42 lakhs 50,000, they have paid more. That is, for 50 lakhs has been paid. Therefore, the income that has to arise in India has gone down by 7,50,000. Therefore, addition to income of AIPL rupees 7,50,000. So the income of AIPL will get enhanced by 7,50,000. Is it clear? So this is what will happen here. So what is the resale price method? Under the resale price method, the application itself will arise only when I purchase from a related party or an associated enterprise and sell it to an unrelated person. Only in these type of transactions, this particular method will be applicable. Now, how will I start off this method? I will take up the unrelated price, which is what price? Sale to an unrelated customer. I will take that price and I will see what is the normal gross profit margin. What is normal gross profit margin? When I sell to an unrelated person, by purchasing from an unrelated person, the margin that I derive is called as gross margin. Okay, the normal gross margin. How is normal gross margin derived? I purchase from an unrelated person, sell to an unrelated person. So this is the normal gross profit margin. Some of you might have this doubt. Sir, suppose my business does not have a single transaction with the unrelated seller. So I don't buy a single item from the unrelated seller. I always buy only from the parent company. Now, how will I apply this method, sir? Because you are telling gross margin, normal gross margin. you have taken the cushion of this 30%. Suppose entire transaction happens here. Every rupee of purchase I make is only from the related party. How can I apply resale price method, sir? Good point. In those cases, what we will do is we will try to find out competitors. Our competitors, what is the gross margin that they are charging? Suppose Acer. So, for example, Lenovo. Lenovo is another professional laptop making company. So, that company has a gross margin of 30%. We will adopt that gross margin and see if there are any functional differences in the gross margin if necessary. Generally, there won't be. If at all there is any, we will adjust that and consider that as the gross margin. So what am I trying to tell? If my business has purchased from a third party and sell to a third party, that will be a gross margin, I will adopt it. Suppose my business does not purchase from unrelated person at all, then what will I do? I will take the gross margin of a competitor, apply that on the unrelated selling price to back work and arrive at the price to be paid for purchases. So what does this method teach us? It is a back working method which starts with sales and comes to the purchases. Okay, so this is the second method, which is the resale price method. And when will it apply? It will apply only to a trading concern. So any sort of manufacturing activity, carried, etc., will not find this method to be useful. Okay, so this is the second method. Now, what are the two methods that we have seen so far? First method is the cup method, second method is the resale price method. What is the cup method? When we have an uncontrolled comparable transaction, we will compare the tainted transaction or the biased transaction with this transaction and check whether they are at arm's length or not. Okay, in doing so, what will we do? If there are any functional differences or transactional differences between these two transactions, where it is present in the international transaction but not present in the uncontrolled transaction, or the other way around, we will adjust to arrive at the arm's length price. Difference between the arm's length price and the transaction price is called as primary adjustment. What adjustment? Primary adjustment, which has to be made by adding to the income and paying tax on the same. Now, when I purchase from a related party and sell to an unrelated person, so it is a resale activity. When the resale activity happens in such fashion, what will I do? I will call it as resale price method. Now what will I do? I will take the final sale price as the starting point because that is an uncontrolled point. So I will take it as a starting point. Now the starting point, what I will do, I will check for normal gross profit margin. What is normal gross profit margin? When I purchase from an unrelated person and sell it to an unrelated person, the margin that I derive is called as the normal gross profit margin. Now, I will then adjust for whatever is the adjustment that are to arise. For example, just like cup method, here there might be purchase related expenses specific to purchases from abroad. So those we will adjust and we will arrive at the arm's length price. Difference between the arm's length price and the transaction price will be the adjustment that needs to be made for income. Okay, so this is with respect to the second method, namely resale price method. Now, let us go to the third method, cost plus method. See, from an examination point of view, the examiner favorite will only be two methods. One will be cup method, and the second one is going to be your cost plus method, because cost plus method has been asked around 2-3 times in the examination. Cup has been asked around 2-3 times in the examination. Okay, whether you will get an extensive question, no, it might be part of a bigger question. Okay, so knowing the method is very important for answering various questions that might come in the due course. Now, what is this cost plus method? Let us take an example. Acer India manufactures basic laptops for online education. Okay, now that COVID has given the importance towards online education, Acer decides to manufacture basic laptops for online education for children, for school children. Okay. Now, this particular transaction, what they do is they make and sell to Acer Japan Inc. So, India makes the computer and it manufactures the computer and it sells to Acer Japan Inc. What does Acer Japan Inc. do? it sells to its customers. So what happens? Acer India manufactures basic computers and it sells to Acer Japan. Acer Japan sells these computers to its customers. Okay, now this happens when ASPL gives order. So ASPL tells boss, deliver so many number of computers to Acer Japan, and Acer Japan in turn will sell, and Acer Japan will directly sell the product without doing any sort of adjustment to it. Okay, now to this transaction, whether I can apply CUP. Now, whether I make similar computers to be sold in India? No, I don't make similar computers to be sold in India. Whether there are laptops manufactured in India for the purpose of online education? There is no such kind of a transaction in India. So there is neither internal CUP nor external CUP. Therefore, I cannot resort to comparable uncontrolled pricing method. Sir, you are telling that AJ Inc. is going to sell. So can I apply resale price method? So second question, whether resale price method can be applied. For resale price, what is going to be the starting point? The selling price to the ultimate customer. Selling price to the ultimate customer is the starting point. So AJ Inc. selling price, do we know? We do not know. Correct? One more thing we need to know. What is that? AJ Inc. gross margin. Do we know that? No, we don't. So when we don't know these two aspects, we can neither apply CUP nor can we apply resale price method. Is it clear? So this makes us come to the next level of learning, which is going to be application of cost plus method. So what is this cost plus method? This cost plus method is the standard method where I am not able to apply the other two methods. What I will do is I will see what is the cost of manufacture. So what can be the cost? First one will be direct costs. Second one will be indirect costs. Then to this I will add normal gross margin to arrive at arm's length price. Okay, so this is how it works. So what will I do? I will take the direct cost, I will enhance it by the indirect cost, I will add the normal margin, normal gross profit margin to arrive at the arm's length price. Now, this normal gross margin, what is this normal gross margin? So if I have an uncontrolled transaction, if I can derive the margin of that transaction, I will use the margin of that transaction, or I will choose to have a margin which is from a relevant business and arrive at the normal gross margin. So there can be again two normal gross margins, where at my own business I can check what is going to be the gross margin, or I can take the gross margin of a competitor to arrive at what is the gross margin to be charged. Okay, so now that we know what this method is, let us look into a problem like what we have done for the earlier two methods to understand how arm's length price is computed. Right. Acer India Private Limited. Again, we will stick on to Acer so that we get the understanding in a better manner. Acer India Private Limited manufactures basic laptops and sells to Acer Japan Inc., an AE of AIPL, an associated enterprises of AIPL. Question has already told whether they are associated enterprises. Yes. Then say transaction is between India and Japan. So one party is a resident, another party is a non-resident. So P and all has not been given in the question. So you don't have to make any assumptions there. Okay. So in that case, what are we to assume? We are to assume that the transaction is between an associated enterprise only, or between associated enterprises. Therefore, the transaction is going to be an international transaction and it is an associated enterprise transaction. Okay. So now, material cost is given as 1 crore, labor cost is given as 60 lakhs, indirect production cost is given as 50 lakhs. Gross profit margin charged by AIPL to Zebronics India Private Limited is 40%. It is Zebronics or Zebronics, does not matter. The price charged by AIPL was 2 crores 40 lakhs. AIPL received technical support from ACER Japan, which was at 10% gross margin, which is not provided by Zebronics Limited. Now AJI is providing a credit facility, 6 months credit facility, which is 5% of the billing value, and the same is not made available to Zebronics. Warranty is provided at 1% of billing value. Now they want us to find the uh, arm's length price. Okay, so now let us understand something. The transaction is between India and Japan. Okay, fine. So let's get started. So there are two things that we need to do. Normal gross profit margin we need to find out, and we need to find out the arm's length price. Okay, so the first step will be to ascertain gross margin. Sir, why should we ascertain gross margin? Sir, it is already given in the question as 40%, sir. Again, when the gross margin percentage is required, the percentage is expressed as transaction between two unrelated parties only. You cannot take between related and unrelated. You cannot take between two related parties. You have to consider it between two unrelated parties. So, what is the percentage given? 40%. Okay. So now the question tells that gross margin, profit or margin to unrelated party. How much is it? 40%. Now, come to the text in the question. AIPL received technical support from AJI Japan, which was 10% of gross profit margin, which was not provided by Zebronics Limited. So, Acer India is getting some sort of a technical support from the Japanese entity. So, Acer India is getting support from Acer Japan. So, which means what? The seller is receiving some sort of services from the buyer. Correct? So, there is a technical support here. So, less technical support received. How much is that? 10% of gross profit margin. What is the gross profit margin? 40%. 10% of that margin is the value of this cost. Therefore, this rate will go down by 4%. Is it clear? So, what are we getting? Technical support is received by Acer India from Japan. Okay, so what will this do? It will reduce the profit percentage for the related party transaction. Unrelated party does not provide such service to the seller, but the related party is providing such service to the seller. So what happens? The profit for related party transaction will be lower when compared to the profit for unrelated transaction. Therefore, what we will do? We will reduce this 4% here. It's nothing but 10% of the 40%. Okay, 10% is the technical service value, and then 40% is the margin. So 4% will be considered here. Then 6 months credit facility is availed for 5% of the billing. So less credit facility. So 5% of billing value. Gross margin is 40%. So operating cost is going to be 60%. So what is billing value? 100%. 5% of 100% will be 5% only. So please don't go wrong here. So 5% of 100% will be 5% only. So credit facility extended by India to Japan is 6 months credit facility extended, which results in a cost of 5%. The margin comes down by 5% because of this credit facility that is offered. Whereas for Zebronics, this particular credit facility is not offered, so the cost will not come down for them. But for this, the cost will come down. Therefore, the cost will come down, the profit will come down. Therefore, the margin is reduced to the extent of 5%. Okay. Then what else is given? Warranty is provided at 1% of billing value for AJI. Therefore, warranty given to AJI. Warranty to AJI. How much is that? 1%. Therefore, margin to be charged is how much? 30%. So what are we telling? The profit margin to an unrelated party is 40%, but to a related party there are certain additional costs that are relevant which will pull down the margin percentage. So we are now doing what? We are applying that and arriving at the margin to be charged, which is 30%. Okay, now that we know the margin, we can go ahead with the ALP determination, arm's length price determination. So this is what method, since we do not have data for cup and for the purpose of RSP, we are forced to follow what method? Cup method. Why cup method? Because direct cost data, indirect cost data, margin data is given. So we can proceed with cup method, CPM method, cost plus method. Okay. So what will we do? We will take the direct costs. Direct costs, what are they? Material plus labor. Material plus labor. So how much is that? 1 crore 60 lakh. Okay. And then the indirect production cost will be the indirect cost. Indirect production cost is 50 lakhs. So what is the total cost? Total cost is 2 crores 10 lakhs. 2 crores 10 lakhs. Now the gross margin that we have found out is 30%, which means what? Gross margin by sales is equal to 30%. So add gross margin, this is 30%, this is 100%, and this is 70%, correct? 70% is the cost, 30% is the margin, 100% is going to be the arm's length price. This is going to be what? Arm's length price. So this is 90 lakhs. Therefore, 3 crores should be the arm's length price. Okay. So what should AIPL charge to AJI? It should charge 3 crores. But what has it charged? It has charged only 2 crores 40 lakhs. So price charged by AIPL 2 crores 40 lakhs. Therefore, addition to income. Addition to income is how much? 60 lakhs. So this will be added to income because this is the transaction price. This is the transaction price. This is the arm's length price. This is going to be the primary adjustment which you will have to make sure that your income is in line with the arm's length price. So this is called as cost plus price. Okay. Don't worry. In the next session or probably after 1 or 2 classes where we try to complete on the entire syllabus of transfer pricing, we will take up problems from past examinations and mock test papers and sort out problems on these particular methods of ascertainment of transfer prices. Okay, so with this we have completed the cost plus method. Now the next method that we will do is method 4, profit split method. So this is the 4th method. What method? Profit split method. See, sometimes if you see, there are certain entities which crop up for a short span of time and then they liquidate. For example, you guys must have come across this particular venture known as Hero Honda. So now there is no Hero Honda, there is either Hero or Honda separately. So Hero and Honda came together for a span of time where they started manufacturing motorcycles under the brand name of Hero Honda. So this is called as joint venture. So generally, companies come together for a particular venture or a specific venture. They operate together. Once the venture is done, they dissolve. Okay. So this is the place where profit split method will be applicable. This is the place where profit split method will be applicable. How do we find that? So what will we do is, we are right now focused only on the Indian entities. From a transfer pricing point of view, we are not bothered about the foreign entities. We are more bothered about the Indian entity and how income is lost by India. So we are more focused on the Indian entity. So cost incurred by Indian entity plus profit share of Indian entity together will constitute what? Arm's length price of Indian entity. Now, let us understand this better with a problem as usual. Okay. Now, AIPL, AJI and ASPL enter into a joint venture for manufacturing specialized computers for space and defense projects. Okay. So there are three entities now. Okay. So entity number 1, entity number 2 and entity number 3. So we have AIPL, ASPL and AJI. So these three come together for a particular venture. So these three together now start up a joint venture. Okay. So let us call it as Acer Space and Defense. Okay, Acer Space and Defense. So this is the joint venture they have come together for. Now, what is the terms of the joint venture? The value of the project is $20 million. So value is equal to $20 million. So this is going to be the revenue of the particular venture. Okay, and this will be split between these three entities. This 20 million will be split between Singapore, India and Japan. In what ratio? 10.5 million. $10.5 million will go for Singapore. $5 million will go to India and $4.5 million will go to Japan. So this is how the agreement is entered into. So this is the agreement between these three entities. Now, what has happened after that? Then, cost of production. So, cost of production is equal to $12 million. $12 million. The contribution ratio in respect of capital employed, risk assumed, manpower, etc. is 50% is to 30% is to 20%. So, contribution ratio based on FAR. What is FAR? Functions performed, assets employed, risks assumed is going to be 50% is to 30% is to 20%. So this is what is given in the question. Now, cost incurred by Indian entity is going to be $3.6 million. 3.6 million. Okay. So now, calculate ALP and also comment. Will the ALP differ if the cost incurred by AIPL is different? Okay. So they have left it blank. They have not commented on the cost. They have left it blank. Okay. So now, the second portion of the question, to comment whether the ALP will differ if the cost of AIPL is different, we will not attempt it right now. We will do it slightly later, but let us focus on understanding this particular method right now. Okay, fine. So how do we start this problem? Now, what did we tell? We told that in the earlier slide, we told that it is going to be cost incurred of the Indian entity plus profit share of the Indian entity. Okay. So now, the question tells us that cost of the Indian entity is $3.6 million. And what is the profit of the Indian entity? We do not know. So first let us focus on finding that out. Okay. So what is the total value of JV? $20 million. Total cost of production that is given in the question, $12 million. Okay, therefore total profit for the JV, total profit for JV, how much is that? $8 million. Correct? The total profit is $8 million. Now, what is the share of profit? They have given in the question as 50:30:20. So, this 8 million will be split between these three. Okay. So, to Singapore, India, and Japan in the ratio of 50%, 30%, and 20%. So, how much is it? 4 million. Then this one is 2.4 million, and this one is 1.6 million. So this is the profit split between these three entities. Okay. Now, what is the cost of Indian entity? Now that we know profit share of Indian entity, do we know the profit share of Indian entity? Yes, we know the profit share of Indian entity. So, cost of Indian entity, or we will call it AIPL. Instead of Indian entity, we will call it as AIPL. Cost of AIPL. How much is it? The question has told $3.6 million. And profit share of AIPL. Profit share AIPL. How much is it? From here, we know that it is 2.4 million. Therefore, ALP of AIPL. What is the arm's length price? It is $6 million. So, what is the meaning of this? From the joint venture, AIPL should get a revenue of $6 million. Okay, so what is the meaning of this? From this joint venture, AIPL should get a revenue of $6 million. So, how did we find that out? We took the total value of the particular venture, we did reduce the cost of the venture, and we arrived at the profit from the venture. Okay, the profit is $8 million. Up to this, it is plain mathematics. Now, the question tells that based on the agreement, the contribution ratio is at 50%, 30%, 20%. So, functions performed, risks assumed, assets employed, assets meaning manpower, etc. employed, they are going to share the profit. Okay, the ratio of 50:30:20%. Okay, so that is 4 million, 2.4 million, 1.6 million. Now, what is the arm's length price? Arm's length price is nothing but cost plus profit share. What is the cost? 3.6 million given in the question. Profit share is going to be 2.4 million, which we have found out. 6 million should be the arm's length price. Go back to the question. What are they talking about? The revenue retained by ASPL. So the revenue of 20 million, 10.5 million goes to Singapore, 5 million goes to India, 4.5 million goes to whom? It goes to Japan. So what is the transactional price? Transactional price is equal to $5 million. Therefore, adjustment to be made will be $1 million. So this will be the addition to income. Okay. So under this method, which is the profit split method, what will we do? We will first ascertain the profit, then split the profit, add profit with the cost, compare the price with the transaction price. The difference will be called as the primary adjustment. Okay. Now, in this example, they have asked us one question. What is that? Also comment, will the ALP differ if the cost incurred by AIPL is different? Okay. Let us take for example. The cost incurred, for example, here is going to be $2.4 million. Okay, $2.4 million. And what is going to be the profit margin based on whatever we have found out here, assuming that total cost does not change. Okay, the total cost has not changed, but cost relevant to India has changed. Okay, or we have now ascertained the cost relevant to India as a slightly different number. Instead of 3.6 million, it is 2.4 million. Cost relevant to India is 2.4 million. And what is the profit relevant to India? That has also not changed. Again, 2.4 million. So when I add these two, I am getting 4.8 million as the revenue to be charged. Arm's length price is what? 4.8 million. But what is the transactional price? Transactional price is 5 million. As an assessee or as an assessing officer, precisely, will I be happy to tell, no, 5 million is not correct, please give revenue as only 4.8 million, or will I simply stay quiet and will stay away from this particular transaction? I will stay quiet and stay away because the assessee himself has come forward declaring a higher income. Therefore, very important thing to note. What is that? TP shall not apply. Shall not apply. This provisions of transfer pricing shall not apply when? If its application results in higher losses or lower income. So in this case, what happens? If the cost reduces to 2.4, adding the profit margin, the overall income has lowered from the declared 5 million, it lowers to 4.8 million, which means what? The very basic purpose of transfer pricing is to do what? Safeguard the interest of revenue. If I apply transfer pricing now, the interest of revenue is affected, so I will not apply transfer pricing here. So what is the end conclusion? In case the cost is going to go down below the point of 2.6 million. Why 2.6 million? Because if cost is 2.6 million, what happens? Transfer price will be 5 million, transaction price will also be 5 million, arm's length price will be 5 million, transaction price will also be 5 million, no problem. But if it falls below 2.6 million, what happens? Your transaction price will be greater than arm's length price, so transfer pricing provision itself will not apply. Is it clear? Transfer pricing provision itself will not apply. The question has to be rephrased. You will have to tell that arm's length price won't vary. Arm's length price will be equal to the transaction price. That's all. Okay. So this is an important point of learning for us. So what is the conclusion? Under the profit split method, what we will do is we will first try to ascertain the total profit of the venture. From the total profit of the venture, we will split it to each co-venturer, and this profit will be added to the cost to arrive at the arm's length price. This arm's length price will be checked with the transaction price, and if arm's length price is greater than transaction price, the difference will be adjusted. Not only this method, any other method for that matter, if transaction price is greater than arm's length price, you will just stop applying the provisions of transfer pricing because already your interest is being protected. You don't have to go and do anything and spoil it. Okay, so this is the conclusion of the fourth method, namely the profit split method. But there is one point that you must know. What did we do with the profit split? So this profit split what did we do right now was comparable split. So what is this comparable split? It is based on contribution ratio. So the entire profit is split based on contribution ratio. Sometimes some co-venturers might choose this method called as residual split. Residual split. So what is residual split? You will have two-way split. You will have two-way split. What is that? You will split one portion based on contribution ratio. What is contribution ratio? 50 to 30 to 20. That is in this example. It can be anything for that matter. It can be anything that will be decided between the co-ventures. So one portion will be split based on the contribution ratio, and then the residual portion will be split on agreed terms. What is this agreed terms? They will tell that based on the risks employed, functions performed, manpower employed, etc., they will choose to have a different proportion, that may be equally or probably 2:1. It can be anything that will be decided amongst the co-venturers. So this is going to be called as residual split method. So how is the residual split method going to operate? the portion will be defined in the venture agreement itself. Up to 60% will be split in contribution ratio, balance 40 equally. So this is called as residual split method. Okay, with this we are concluding on the fourth method, which is the profit split method. Then the fifth method and the final method is called as transactional net margin method. This transactional net margin method is the most commonly used practical method. So what they will do is they will ascertain the net margin of competitors or comparable companies. Okay, why is this method resorted to? Ascertaining gross margin might be difficult at some points in time, so you might not get sufficient data to conclude based on that. Then the next area why we will resort to this is because we may not have comparable and controlled transaction to check with. Then we may not have the breakdown of direct cost and indirect cost of comparable companies. Then we may not have sufficient data on the resale price. So where there is absence of data, you always know that net profit is going to be an easily ascertainable number. So what they do is generally, when you try to apply this in practical life, you have two databases called as Progress and Capital Nine. See, these two databases, what they do is that they try to apply and get the data that is relevant for application of these five methods. So if you check into these databases, enter the requirement of your company. For example, my company is a 1,000 crores turnover company. I put that into Progress. It will throw out whatever is the comparable companies for my company. Okay, so based on the nature of business, type, level of turnover, profit margin, etc., I will get comparable companies. And where I am not able to get data that will be helpful for the four methods that we have discussed so far, I will simply resort to the transactional net margin method, apply the net margin as the base for the purpose of identifying the arm's length price. That's it. So this is the residual method that will generally be applied if data is not available for the other methods. Now, with this, we are completing on the five methods. Sir, whether there is any problem requirement, no problem requirement for TNM, it is going to be fairly simple. Just the net margin has to be considered. Comparable net margin will be applied on the selling price to arrive at the cost. If the cost is a mismatch, then you will have to do an adjustment. Okay. Likewise, you will have to see what is the price to be charged, and then based on that, you can do a mark adjustment accordingly. So what will I do? I will tell selling price minus comparable net margin. That will give me the cost. So this will be the arm's length data. I will check it to the transaction price, and then I will do the adjustment. So this is what happens under the transactional net margin method. Okay, so now the next issue is that, sir, you have told four methods where we have specific ways of ascertaining what is the arm's length price. So suppose my company has four comparable companies. Okay, so my company, I am comparing it with four relevant companies for the purpose of transfer pricing study. Okay, and I am resorting to cup method. So I am using cup method, and company 1, company 2, company 3, and company 4. There are four companies. And after getting the data of these four companies, because my company is similar to these four companies, I am getting the data of these four companies, and I am able to get the external cups from these four companies, and I arrive at the transactional arm's length price at 200 rupees for company 1. Based on company 1's data, I am telling that arm's length price is 200 rupees. For company 2, the arm's length price is 210 rupees. For example, for company 3, it is 205 rupees. For company 4, it is 195 rupees. These four companies are relevant to my company for the purpose of determination of arm's length. Okay, so now I have four prices. Which price will I choose? Which price will I choose? Now, for this, there is a section called as section 92C2. What does this tell? It asks you to take the simple average. simple average. So how will I take simple average? 200 plus 210 plus 205 plus 195 divided by 4. Therefore, arm's length price will be 202.5. What should I do? According to 92C2, up to 5 prices. Up to 5 prices. So I have applied the transfer pricing study. 4 companies were found suitable. So what I have done, these 4 companies I have arrived at the transfer price. Now I want to know which price to choose. What should I do? Add the price of all 4 companies and find the simple average. Okay. So this will be the arm's length price. Suppose I get 5 prices, still do the same thing. Suppose I get 3 prices, do the same thing. Suppose I get 2 prices, still do the same thing. Suppose I get 6 prices, do not do simple average. Do not do simple average. We have a separate way to determine arm's length price for that. So we'll keep that for the next session. So what is the takeaway from 92C2? Apply any of the methods that is relevant, first thing. Okay. And after that, arrive at the transfer price. If you get more than one price, for example, you get more than one price and you get up to 5 prices, you can choose what is called as simple average. Now 202.5 is the simple average. Now it does not stop here. It gives one more benefit. What is this one more benefit? It is called as tolerance band. It is called as tolerance band. What is this tolerance band? See, often the assessee and the income tax department keep fighting over the point of no, this should be the ARP, no, that should be the ARP and all that. So the income tax fraternity wanted to give a tolerance limit. They told that as long as the limit does not cross 3% of transaction price. Transaction price. Do not mistake it. It is not arm's length price, transaction price. As long as the limit does not exceed 3% of the transaction price, it will be considered as the arm's length price. So what is the meaning of this? Suppose the transaction for which I am doing this entire exercise, I am taking a transaction, I want to check whether it is at arm's length. Okay, the price charged for the transaction is 200 rupees per unit. I have charged the price as 200 rupees per unit. Okay, so now based on 92C2 tolerance band, I have to apply 3% on this. How much is it? 6 rupees. Okay, so if the price is between 194 rupees to 206 rupees, this is the tolerance band, plus or minus 3%. Okay, it can be less by 3% or more by 3%, not a problem. If my price band is within this limit, then I am fine. What is the arm's length price? Arm's length price is 202.5. Whether this 202.5 is within the bandwidth of 194 to 206, yes. Therefore, 200 will be the arm's length price. So they are giving you a benefit. What are they telling? Make sure that arm's length price is within 3% of transaction price. If arm's length price determined is within 3% of transaction price, then your transaction price itself will be arm's length price. Is it clear? So, first find out arm's length price, keep it aside. Then take up your transaction price, apply 3%. Now, if this 3% plus or minus is giving you the bandwidth which lies within the arm's length price, then you will not have to change your transaction price. Your transaction price itself will become arm's length price. Suppose this 202.5, it is, for example, 212. It is 212. Then you cannot take transaction price as 200. You will have to pass an adjustment for 12 rupees. You will have to take an adjustment for 12 rupees. So what are they telling? First find out transaction price, apply 3% on that. Plus or minus can be the adjustment we will accept. Your arm's length price should be within this range. 194 to 206 should be the range within which your arm's length price should lie. Okay. Suppose your arm's length price is within this bandwidth, then your transaction price itself you can take it as arm's length price. But if your arm's length price crosses beyond this limit, if your arm's length price crosses beyond this limit, what will happen? You will ignore this bandwidth and you will accept the arm's length price difference between the arm's length price and transaction price. Difference between the arm's length price and transaction price will be the primary adjustment that you will take. Is that clear? Now, if there is going to be a wholesale business, in place of 3%, you will have to consider 1%. That is the only change for the wholesale business. So what will we do? Under section 92C2, we will have to see whether there are multiple prices that are available with us, and such multiple prices should not exceed 5. So when there are 5 multiple prices, we will add up all the price and take a simple average, call that as arm's length price. Now we will take up our transaction price. We will take up our transaction price and apply 3% to the transaction price. That will give us the acceptable tolerance band. This tolerance band should be the limit within which the arm's length price should lie. If the arm's length price is within this tolerance band, then transaction price will be taken as arm's length price. But if the transaction price is above the tolerance band, then you will ignore the tolerance band. Transaction price versus arm's length price, the gap will be adjusted as addition to income. Suppose the arm's length price is lower than this tolerance band, kindly ignore arm's length price because you are only going against the interest of revenue. Stay along with the transaction price itself. Okay, now this is with respect to section 92C2. There is one more section, section 92C3. Now, what has happened? Acer Limited has filed its return of income, okay, and it has also assessee which is covered under transfer pricing provisions. So it has gone ahead and given the transfer pricing report. Okay, what is this report? We will discuss at a later point in time. Just keep it on board. Now, what has happened? The assessing officer has transferred the case to a transfer pricing officer. Okay, so if you see in Chennai, Greaves Road, there is an income tax office. This income tax office has 2 divisions. One division will take care of the TDS wing, and the other division which takes care of the transfer pricing wing. Okay, so this office is where the transfer pricing assessments happen. Now, this TPO comes across 4 cases. He comes across 4 cases. Case 1. What is case 1? Acer should have applied cup method. Instead, what they have done, they have gone ahead and applied CPM method. So what have they done? They have not applied the most appropriate method. What is section 92C telling? I am giving you 5 methods. Please apply the most appropriate method, not the method which you like. Okay. So what has the assessee done? The assessee has applied the wrong method when he should apply something else. Case 1. Then, assessees. Now, Acer Limited is a 500 crores company. So the turnover of Acer India is 500 crores. Now, Acer has taken 5 comparable companies. It has taken what? 5 comparable companies. Every company's turnover is between 100 crores to 250 crores. Every company's turnover is between 100 crores to 250 crores. So what has gone wrong here? The data used for ALP determination is incorrect. So arm's length price determination data that was used for it is incorrect. So what will happen here? We will have to not consider whatever ALP that we have identified. Not to be, the AO will not accept it. AO will not accept if you choose the wrong method. AO will not accept if the data that you have used for ALP determination is wrong. No. When you run into these international transactions, you are supposed to maintain some documentation. You are supposed to maintain some documentation in accordance with section 92D. When we come across that section, we will elucidate as to what are the information that is required to be maintained. You fail to maintain these data. Now, the TPO calls for information. He says, boss, you have presented 3 transactions. Please share information regarding these transactions. You fail to produce information and documentation under section 92D. This we will study in detail, but for the time being, for the limited purpose of understanding arm's length price, These are the 4 conditions. What are they? Incorrect method chosen. 2. Data consideration for the method is wrong. 3. Documentation for international transaction is not maintained. 4. The documentation and information when called for is not produced by the assessee, then AO will simply not accept whatever transfer pricing study you have done. He will determine AO. He will determine ALP. The AO will determine ALP by his own self. So he will rework the entire process and arrive at the arm's length price. But he will give an opportunity of being heard to the assessee. So what he will do is, he will send a notice to the assessee calling for why, show cause why the arm's length price cannot be determined under this method. Show cause why arm's length price has been determined based on these particular comparables. Show cause why you have not produced the data. Show cause why you have not maintained the data. So he will give you a show cause notice. You will have to respond to the show cause notice, and if he is satisfied, he will accept your method. Otherwise, he will go ahead and redetermine the arm's length price by his own self based on the method he feels fit. This is section 92C3. So what is this section talking about? Cases where AO will determine the arm's length price by himself. Last section for the day, section 92C4. Effect of ALP by AO. Now, if the AO is going to determine the arm's length price, what is going to be the consequence? Let us understand something. Let us take an example so that the understanding will be far better. Now, let us understand that I am a company who is registered under Special Economic Zone. I am under Special Economic Zone. This is my second year of operation. So what happens? I get 100% benefit of deduction under Section 10AA for exports turnover made. So assume that PGBP, profits and gains of business or profession, is going to be 100 crores. Okay. Export turnover is 50 crores. Total turnover is 100 crores. So which means what? 50% of my turnover are exports. Therefore, 10AA exemption that I will get, or the deduction under section 10AA, will be 100%. So how much is that? 50 crores is the deduction I will get towards the taxable income. So what will be my taxable income now? Taxable income will be 50 crores. Okay. So this is what has happened. I have filed my return of income telling that 50 crores is my taxable income. Now, there are 3 transactions which are covered under transfer pricing. One of the transactions which I have reported under CUP method, but the income tax officer feels that it should be reported under cost plus method, so he makes an adjustment. After adjustment, PGBP income adjusted is 140 crores. PGBP income adjusted is 140 crores. Export turnover does not change. It is 500 crores, 50 crores, is it? Yeah, 50 crores. Export turnover is 50 crores. And total turnover is 100 crores. Okay, let us keep it as 500,000 because PGBP is 100, right? So 500 crores is export, 1000 crores is total turnover. Okay. Now, actually applying 10AA, what should be the benefit that I will get? When I apply 10AA, I will tell PGBP multiplied by export turnover by total turnover, which means what? 140 into 500 by 1000, so 70. But since this adjustment is made by the assessing officer, the incremental income added by the assessing officer will not be eligible for the 10AA benefit, which means what? Still my benefit will be only 50 rupees, 50 crores. 90 crores will be the taxable income. Why, sir? See, try to understand. This particular exercise is only trying to tell that you have not offered income which should have been offered by adopting wrong method. So they have found out the right method in which the income has to be determined. That will not be eligible for any sort of 10AA benefit or 6A deductions. If you see under chapter 6A, there are certain deductions which are income based deductions starting with section 80I. These benefits will also be denied if the income is enhanced by the assessing officer. Okay, so where income is enhanced by the assessing officer, no benefit will be available for the enhanced portion by means of 10AA or 6A deductions. Okay, therefore your taxable income will not get the benefit of 10AA for the enhanced portion. Now, case 2. Now, AIPL makes payment to ASPL. The payment is royalty at rupees 100 crores. Okay. Now, ASPL is receiving royalty, therefore under section 115A, they are subject to a tax of 10% which will be deducted. Therefore, what will be the royalty received? Royalty received by ASPL will be 100 minus 10, 90 crores will be received by them. Okay. So under section 195, tax has to be deducted. Rate will be as per section 115A, 10%. Now AO has taken up this particular transaction for assessment. He feels that 100 crores is overpriced. It cannot be 100 crores, and he redetermines the royalty. He redetermines the royalty as 80 crores. So what will happen now? AIPL would have debited its profit and loss account for 100 crores. Okay, so because of this, the income that needs to be offered to tax has got reduced by 20 crores. So the AO is now correcting the royalty payable and he calls it as 80 crores. Now because of this, what happens? The P&L debit will now fall short by 20 crores and the P&L has to be debited only for 80 crores. But this will not have any impact on the income received by the Singapore entity. Which means what? Tax has to be deducted at 100 crores. Okay, but deduction will be allowed only for 80 crores. So this is what is considered as the adjustment to be made by the assessing officer. So the assessing officer penalizes the Indian entity for overcharging the expenditure, reduces it, but he does not let go of the same and gives the benefit to the foreign entity. He still considers that the foreign entity will have to pay tax or deduct tax at the original transactional value of 100 crores. So this is the effect of adjustment made by the TTO or the assessing officer. What is the effect? Effect number 1, 6A benefit, 6A deductions or 10AA benefit will not be given for the income enhanced by the assessment. Point number 2, where the income of one party is being adjusted by the AO, the income of the other person will not be adjusted. Income of the other person will not be adjusted. Okay, so with this we are concluding on section 92C4. So what have we seen today? Section 92C, which gives us an understanding on 5 methods of ascertaining your arm's length price. 1 being cup, 2 being resale price method, 3 being cost plus method, 4 being profit split method, 5 being transactional net margin method. Rule 10AB talks about another method which is any other method prescribed, which is a tailor-made method which will be applicable only if any of these methods are not possibly be applicable. Then the next section we saw was section 92C2, which speaks about the simple average of prices to be considered where there are more than one price up to 5 prices. And then the next thing that we saw was tolerance band of 3%, which is applicable when there is going to be a fluctuation of 3% over the transactional price, and arm's length price has to be within this bandwidth. Then the next point that we saw today was with respect to section 92C3, where there are 4 cases under which the transfer pricing officer or the assessing officer will do the assessment and arrive at the arm's length price. And 92C4, what is the effect if the assessing officer is going to do the determination of ARP? Now, what are we to see beyond this? We were discussing about 5 arm's length prices. What suppose I get 7 arm's length prices, what will I do? There is something called as a range concept that we will be discussing in the next session. Then there is something called as advanced pricing agreements that also we will be discussing in the next session. Okay, so please take the handouts with you which is given as part of the description. You will be requiring me to understand what we have discussed today in terms of the methods. And in the forthcoming classes, you will be having a set of problems which will be given for solving out and understanding the methods of determining arm's length price, and the consolidated case studies or integrated case studies which we will see for the purpose of application for MCQs. I'm just waiting for more concepts to be covered so that it will give us a wider range in understanding transfer pricing. Okay guys, so we end up for today's class. Thank you.